Our instincts suggest keeping our money completely still. Stashing cash in a heavy, immovable iron safe feels like the ultimate act of preservation. However, that stillness is deceptive. While the bills remain physically intact, their purchasing power is actively eroding. Inflation and the missed opportunity to generate returns mean that static money is actually in a state of slow decay. If doing nothing guarantees a loss, every decision becomes an active bet. We are forced to commit resources today, even though we have no way of knowing what tomorrow looks like. Finance provides the framework for navigating this uncertainty. It functions as a behavioral toolkit for managing money across different points in time. Understanding this framework changes the nature of money itself. It stops being an object to hoard and becomes a tool for navigating an unpredictable world. The baseline rule of the financial universe is that a specific sum of money in your hand right now is worth more than that same sum promised to you in the future. This is a matter of utility. Money held today can be immediately put to work to earn a return, whereas a future promise carries no such guarantee. This chart illustrates the result of that utility over time. Compounding happens when initial returns generate subsequent returns. A slow, linear crawl eventually curves upward into an accelerating snowball effect. Comparing two starting points reveals a massive disparity. Because compounding needs duration to reach its vertical phase, an early investor gains a mathematical advantage that is almost impossible for a latecomer to overcome. In this system, time acts as the structural engine of wealth, often carrying more weight than the raw amount of capital invested. If time is the engine, risk is the accelerator. In the market, it is impossible to pursue higher returns without simultaneously accepting a higher degree of uncertainty. To manage this trade-off, investors choose between two primary mechanisms: debt and equity. Debt is the act of lending. As this flat line shows, it offers the safety of a fixed interest payment, but strictly limits how much you gain. Equity, or ownership, removes that ceiling. It exposes the investor to high volatility and total loss, but unlocks potential for unlimited growth as the asset succeeds. Every investor has to decide where they want to sit on this spectrum, balancing their immediate need for safety against their long-term requirement for growth. Risk, then, is a functional dial. It is a tool we adjust deliberately based on the goals we are trying to reach. Eventually, we have to synthesize these concepts to answer one practical question: is any given asset actually worth its asking price today? We answer this through valuation. This is the process of estimating the total amount of cash an asset will generate throughout its entire future. Think of this as a scale. We adjust the weight of future cash flows based on investment risk and how long we have to wait. These factors converge to produce a single estimate of worth right now. The final step is comparing that calculated value directly against the current market price, revealing whether the market is overestimating or underestimating the asset's potential. While the price tag represents the market's collective guess, valuation serves as the investor's rational mathematical compass. These variables, time, risk, and valuation, interlock like a clockwork mechanism. They form the unseen structure driving how we make choices about our lives. But calculations only provide the map. The investor still has to walk the path. Financial mastery requires the emotional discipline to stick to these rational principles, even when the market creates a sense of panic or euphoria. Ultimately, every financial decision involves weighing your desire for comfort today against your requirements for prosperity tomorrow. Finance is a continuous behavioral negotiation with the future itself.